Hello fellow intelligent investors, my name is René Zellman and in this video I want to talk about fees. More specifically I want to talk about the 2 and 20 fee charged by hedge funds for managing investors' money. And we will look at a backtest conducted by Terry Smith and check out how investors who invested along with Warren Buffett, so the best investor of all time, how they would have fared if Buffett had charged such a 2 and 20 fee. To give you a glimpse of what we will do in this video, let me just show you this graph here. The graph is taken from Terry Smith's book, Investing for Growth. And essentially the graph shows how poorly Berkshire investors would have performed if Buffett charged a 2 and 20 fee like almost every other hedge fund manager does. But before we take a closer look at this graph, let me just quickly make you familiar with the structure of this video. First, I will briefly explain how the 2 and 20 hedge fund fee structure works. Secondly, I will outline why hedge funds or mutual funds are very likely a bad investment choice and how you can easily beat them because as a private investor, you actually enjoy some significant advantages over institutional investors. And lastly, I will mention an alternative fee structure approach that was basically invented by Buffett himself. And without further ado, let's get started.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Zellman and I'll teach you how you can manage and invest your money with confidence, a long-term vision and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Okay, before we get started, please consider hitting the subscribe button and the notification bell. This channel is fairly new still. I think it's only my third month of uploading videos. And obviously commenting or liking the video would help me out a great deal to grow the channel. So before we get to Terry Smith's graph, we first need to define what the 2 and 20 fee structure is all about. Well, 2 and 20 is a hedge fund compensation structure consisting of two components, A management fee, and B, a performance fee. The 2 in the 2 and 20 stands for 2% and represents a management fee, which is applied to the total assets under management, in short AUM. And the 20 refers to the standard performance or incentive fee of 20% of any investment gains made by the fund, above a certain predefined threshold. And both fees are usually annual fees. So just to be clear here, the 2% management fee on assets under management is charged regardless of the performance of the investment under the fund manager. And by contrast, the 20% performance fee is only charged when the fund's profits exceed a prior agreed upon level. For example, assume a fund with a 5% threshold level generates returns of 12% for the year. Well, then the 20% performance fee will be charged on the incremental 7% profit above the 5% threshold. Now, if the hedge fund manages assets worth millions of dollars and makes a sizable profit, the income of the hedge fund will be very significant in making, hedge fund managers some of the highest paid financial professionals. Now, hedge funds will obviously justify the 2 and 20 fee structure by pointing out that they have to pay for staff salaries, administrative and office expenses, and obviously other operational expenses. The 20% performance fee will be justified by pointing out that it basically works like or function as an incentive for fund managers so that they strive for the best possible returns. And quite frankly, I think that is complete nonsense, and we will get to this now. Well, just to be clear, the ultimate goal of the video is that you understand the impact of these fees on your overall investment returns. So let me just illustrate why these hedge fund fee structures can cost you a fortune. All right, for starters, did you know that 95% of finance professionals can't even beat the S&P 500 index fund, at least over the long term? And in fact, statistics like that aren't hard to find. Each year, academic studies are conducted which compare the returns of actively managed funds to the returns of passive index funds or ETFs. And this underperformance is mainly caused by two factors. A, flawed incentives of the investing industry, And unfortunately, we won't have the time to take a close look at the underlying incentives of hedge or mutual funds. And maybe I'll do another video on that at some point. And B, the fees that you have to pay. In fact, a fund manager may be able to perform better than the typical index fund like the S&P 500. However, the fees charged by them will dramatically eat your investment returns. Just like the accelerating effect compound interest has on the growth of savings, the same thing happens in the opposite direction when investment fees compound. Paying just 1% in fees can potentially cost you hundreds of thousands of dollars. And I want to illustrate this right now. So let me just show you how high and percentage-based fees that hedge funds charge for their service can affect your long-term investing success. Let's assume you would invest $10,000 today into an index fund that provides a return of 8%, and then you plan to invest for the next 30 years. If you buy the fund yourself, you probably pay as low as maybe 0.1% in fees. That's what you pay for most ETFs nowadays. Let's say you go with a hedge fund that also generates 8% in returns each year. You will obviously have to pay fees, as we have outlined, likely a performance fee and a management fee. Let's assume you're lucky and you can find a hedge fund that only charges you 1% in fees. Well, guess what? You will lose around 25% of your earnings due to the fees. Your $10,000 investment would be worth $100,000 in 30 years if you had invested yourself into a passive index fund. If you would have gone with a financial advisor and maybe a hedge fund, you'd only get around $75,000 and lose roughly $26,000 in fees. Now, let's assume you're not so lucky as to escape with only 1% in fees, but would be charged 2% annually instead, plus maybe an additional 2% contribution fee, which is a fee paid for the initial contribution or investment in the fund. If you would invest $10,000 at the start and then continue to contribute $1,000 each month, here's how your performance would look like. This graph clearly illustrates how the cost of fees accelerates over time. Overall, you would lose $500,000. If you want to do the math yourself, I can only recommend playing around with the investment fee calculator. I'll add a link to such a calculator in the description box below. All right, now let's finally turn to the Terry Smith graph that I showed you in the intro to this video. So far, we haven't really considered the performance fee component, the 20 of the standard 2 and 20 fee structure formula. Well, here's what Terry Smith thinks of this 2 and 20 fee structure. I am not so much shocked as flabbergasted by the number of people who do not realize the impact of these performance fee structures. I'm not talking here about the fact that such a performance fee structure clearly led many fund managers to gear up their funds as much as the credit bubble allowed and place bets which many attendees at Las Vegas would regard as outrageous, knowing that they had little or no downside and 20% of the upside. I have had discussions with numerous professionals in sophisticated jobs in the investment industry who are either unaware of or disbelieve the mathematics of what I'm about to demonstrate. Smith then illustrated this with the performance of Warren Buffett himself. If you had invested $1,000 in Berkshire Hathaway in 1965 and never sold your shares, your initial investment would have become $4.3 million by 2009. That's quite impressive. Buffett, who can certainly be considered the best investor of all time, was able to generate a compounded annual growth rate of 20.46% over that period. If, however, Warren Buffett had set up Berkshire Hathaway as a hedge fund and charged a 2 and 20 fee, your $1,000 would have only grown to around $400,000 by 2009. Only $400,000 would belong to you, the person risking his or her money. And naturally, this also means that of the $4.3 million that you would have earned without fees, roughly $4 million would belong to the hedge fund. So here's Terry Smith's conclusion. 2 and 20 does not work. That does not mean that 1.5% and 15% is okay, or even 1% and 10%. Performance fees do not work. They extract too much of the return and encourage risky behavior. The only way to focus your fund manager on performance without gifting him or her most of your returns is to ensure he or she invests a major portion of their net worth alongside you in the fund and on exactly the same terms. Now, interestingly, even if Buffett would have charged a 2.20 fee to run Berkshire Hathaway, investors would still have outperformed the S&P 500, as $1,000 invested in the S&P 500 in 1965 would have turned to $54,900 by 2009. But now consider the chances of a random fund manager being able to achieve similar returns, similar long-term returns like Warren Buffett. I think it is fair to say that the chance is zero. And Buffett agrees with me here. In 2007, he wanted to bet $1 million that over 10 years, an index fund would outperform a collection of hedge funds if fees, costs, and expenses are included. And a company called Protégé Partners LLC accepted the bet. Buffett chose an index fund that charges an expense ratio of just 0.04%. And in 2017, he won the bet. So, I think it can be concluded that the 2.20 fee structure is basically robbery. It's a ripoff. The hedge fund manager's interests are simply not aligned with investors' interests, and the fee structure essentially only delivers good results for the hedge fund managers, but not for the individual investor. And that's because of these outrageously high fees. Warren Buffett himself wrote in 2016 in a shareholder letter, "When trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outsized profits, not the clients." Okay, before I get to Buffett's alternative fee structure, please let me know in the comments down below whether you know someone who is invested in mutual funds or hedge funds. Have you ever tried to show them the impact investment fees can have on their total returns? I would love to hear thoughts on this. Okay, as the hedge fund manager only benefits from the upside and has pretty much no downside risk, he or she has no skin in the game, as Nassim Taleb would put it. They rarely have a significant stake in their own fund. But of course, there are alternative fee structures. Buffett's investment partnership, which he closed in 1969, or Monish Paprai funds, for instance, took a different approach. During Buffett's partnership days between 1956 and 1969, he implemented a 0.625 fee structure. Put in a nutshell, there is no flat rate charged on total assets under management. Both Buffett and Paprai would charge no management fee and only a performance-based fee. Clients basically only started paying a fee if the fund manager, so namely Buffett or Paprai, would provide them with a return of at least 6%. If the performance falls above that number, they would take 25% and investors would receive the rest. Now, to be fair, the argument against this fee structure could be that it encourages investors to shoot for the moon. If the fund manager doesn't achieve a return of at least 6%, he or she makes no money. By contrast, a fixed management fee guarantees that managers get paid, so they may not feel pressured to take action if there are no attractive investment opportunities. I think whether a fund manager would feel incentivized to shoot for the moon would depend on the temperament of the individual fund manager, but maybe more importantly, on whether he or she also has a stake in the fund. What people usually like about Buffett is that he has always treated his investors fairly. He has treated them like partners. And even after closing down the partnership in 1969, Buffett only earned an annual salary of $100,000 per year as the CEO of Berkshire Hathaway. And this figure obviously seems or appears ridiculously little compared to the excessively paid hedge fund managers. Moreover, one should point out that pretty much 100% of Buffett's net worth was and is tied to the success of Berkshire Hathaway, clearly aligning his interests with investors' interests. Alright, to wrap it up here. The goal of this video was to raise awareness for the impact of these fees on your total investment returns. If you have friends and family that invest alongside a hedge fund manager, you might want to show them the video so that they can take a closer look at the underlying fee structure of the fund they are invested in. I think it can safely be concluded that keeping fees low matters. Just keep in mind that the more fees you pay year after year, the less money you will have to compound for you. Unless you are working with a truly outstanding fund manager, and you probably aren't, it is simply not worth it. And that's probably why ETFs have become so popular. And if you yourself carefully choose just a handful of high-quality businesses to invest in, and if you maintain a long-term focus, you can reduce investment costs even further. So clearly, as an individual investor, you have an edge here. And with that being said, may your finances and investments prosper. I see you in the next video.